How to make money fast, but with high risk. Investors recognize that when an investment vehicle provides a high rate of return in a limited period of time, it's a risky investment. Many investments have the potential to double their initial principal amount given enough time, but many investors are enticed by the promise of high yields in a limited period of time, despite the risk of unattractive losses. Make no mistake, there is no way to guarantee that any investment would double your capital. However, there are several examples of investments that have doubled or increased in value in a short period of time. There are hundreds of failures for any one of these, so the onus is on the consumer to be cautious. Today, we will tell you about how to make money fast, but with high risk. Before we start, go ahead and subscribe. Also, press the bell button to get the latest updates. Without any further delay, let us start. First, we have investing in options. Investors who try to time the market with options will make a lot of money. A stock or commodity equity can be purchased at a fixed price within a future date range by an investor who purchases options. The investor does not have to buy or sell the option security if the price of the security turns out to be less attractive during the future dates than the investor expected. This type of investment is particularly risky since it requires the acquisition or selling of securities to be completed within a certain amount of time. Skilled investors also avoid market timing, which is why options can be both risky and lucrative. Next on the list, we have initial public offerings. Some initial public offerings or IPOs, such as Snapchat's in the mid-2017, drew a lot of scrutinies that can distort valuations and the conclusions professionals offer on short-term returns. Other IPOs are less high profile and may give investors a chance to buy shares when a stock is severely undervalued, leading to high short and long-term returns until a correction in the price of the company occurs. Most initial public offerings, including Snap, fail to produce substantial returns, if any at all. Twilio Incorporated, TWLO, a cloud networking firm that went public in June 2016, raised $150 million at an initial public offering IPO offer price of $15 per share. Twilio was up 90% on its third day of trading and up 101% by mid-December. IPOs are risky because despite the company's attempt to reveal details to the public in order to gain the SEC's approval for the IPO, there is still a high level of confusion regarding whether management can execute the required duties to move the company forward. Next on the list, we have venture capital. The future of startups seeking venture capitalists' funding is especially bleak and unpredictable. Many startups struggle, but a very few succeed in providing high-demand goods and services that the public desires. Even if a startup's product is appealing, poor management, marketing efforts, and even a poor location can stymie its development. Low transparency in management's perceived ability to carry out the requisite functions to sustain the company is one of the risks of venture capital. Many startups are fueled by brilliant ideas from non-business people. To confidently determine the viability of brand new businesses, venture capital investors must conduct additional research. Minimum investment amounts in venture capital are typically very large, which can be difficult for certain investors to meet. If you are thinking of investing in a venture capital fund or making an investment, make sure you do your homework first. Next on the list, we have foreign emerging markets. A country with a rising economy can be a great place to put your money. Investors may purchase government bonds, securities, or sectors in the nation that is experiencing hypergrowth, as well as exchange-traded funds or ETFs that reflect a growing equity market. From 2010 to 2018, China was in this situation. Economic growth spurts are unusual occurrences that, while risky, may provide investors with a slew of brand new opportunities and companies to invest in to diversify their portfolios. The greatest risk in emerging markets is that the duration of extreme growth will last less time than investors expect, resulting in disappointing results. In countries undergoing economic booms, the political climate can shift quickly, altering the economy that previously supported growth and innovation. Next on the list, we have REITs. REITs, or real estate investment trusts, pay large dividends to investors in return for government tax breaks. REITs invest in industrial or residential real estate pools. REITs are subject to fluctuations based on changes in the overall economy, interest rate levels, and the current state of the real estate sector, which is known to prosper or suffer deflation due to the underlying interest in real estate projects. REITs are risky investments due to the extremely volatile nature of the real estate market. Although REITs have the potential to pay high dividends, there is a significant risk associated with the initial investment. REITs with the highest dividend yields ranging from 10 to 15% are also the riskiest. Next on the list, we have high-yield bonds. High-yield bonds, whether issued by a foreign government or a high-debt firm, may give investors astronomical returns in exchange for the risk of losing their principal. In a low-interest rate setting, these instruments can be especially appealing when compared to current government bonds. Investors should be mindful that a high-yield bond yielding 15 to 20% mark may be junk, and the initial assumption that multiple reinvestments would double a principal should be weighed against the risk of losing all of their money. High-yield bonds, on the other hand, do not always fail, which is why they can be profitable. Next on the list, we have currency trading. Currency trading and investing may be better left to the experts, as rapid shifts in exchange rates expose sentimental traders and investors to a high-risk climate. To minimize additional risks, those investors who can manage the added stresses of currency trading can look for trends in the specific currencies before investing. Currency markets are intertwined, and shorting one currency while going long on another is a standard strategy to shield portfolios from further losses. Currency trading, also known as forex trading, is not for the faint of heart. That's all for today, folks. Tell us in the comment section what is your point of view. See you soon with yet another amazing video.